Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 7, Unit 2, that is Final Accounts of Manufacturing Entities. This is lecture number 1. Let us begin. Chapter 7, Preparation of Final Accounts of Sole Proprietor. Unit 2, Final Accounts of Manufacturing Entities. Let us begin with the learning objectives. After studying this unit, you will be able to understand the purpose of preparing manufacturing accounts, learn the items to be included in manufacturing account, draw manufacturing account for manufacturing entities. Overview of the unit. Manufacturing business entities. Final accounts of manufacturing entities consist of manufacturing account, trading account, profit and loss account, and balance sheet. Trading, profit and loss, and balance sheet, these three accounts need to be prepared in trading entities and manufacturing business entities. But in manufacturing business entities, one additional accounts need to be prepared, that is manufacturing account. This is also called as cost sheet. So manufacturing account, trading account, profit and loss account, and balance sheet. As I told you before, profit and loss account is also known as income statement. Trading and P&L both together known as income statement, and balance sheet is known as statement of financial position. Statement of financial position. It is also known as period statement, and it is known as position statement. Position statement. I believe you understood. Introduction. The manufacturing entities generally prepare a separate manufacturing account as a part of final account in addition to trading account, profit and loss account, and balance sheet. The objective of preparing manufacturing account is to determine the manufacturing cost of finished goods, for assessing the cost effectiveness of manufacturing activities. Manufacturing cost of finished goods are then transferred from manufacturing account to trading account. Trading account shows gross profit, while manufacturing account shows cost of goods sold, which includes direct expenses. Manufacturing account deals with raw material, work in progress, and trading account deals with finished goods only. Purpose of preparing manufacturing account. A manufacturing account serves the following functions. First, it shows the total cost of manufacturing the finished product and sets out in detail with appropriate classification the constituent element of such cost. It is therefore debited with the cost of material, manufacturing wages and expenses incurred directly or indirectly on manufacture. Second, it provides details of factory cost and facilitates the reconciliation of financial books with cost records, and also serves a basis of comparison of manufacturing operations from year to year. Third, manufacturing account may also be used for other purposes. For example, if the output is carried to the trading account at market price, it discloses the profit and loss account or manufacture. Similarly, it may also used to fix the amount of production of profit sharing bonus when such schemes are in force. Manufacturing cost, how to calculate it. Manufacturing costs are classified into raw material consumed plus direct manufacturing wages plus direct manufacturing expenses plus direct manufacturing cost. So material, wages, that is labor and expenses, plus indirect manufacturing expenses plus manufacturing overheads equal to total manufacturing cost. Raw material consumed is arrived at after adjustment of opening and closing inventory of raw materials. So raw material consumed equal to opening inventory of raw material plus purchases minus closing inventory of raw material. Raw material consumed equal to opening inventory plus purchases during the year minus closing. So this is consumed. If there remain unfinished goods at the beginning and at the end of accounting period, cost of such unfinished goods, also termed as work in progress, is shown in the manufacturing account. Opening inventory of work in progress is posted to the debit of manufacturing account, and closing inventory of work in progress is posted to the credit of manufacturing account. Direct manufacturing expenses. Direct manufacturing expenses are cost other than material or wages which are incurred for the specific purpose or saleable service. Examples of direct manufacturing expenses are royalties for using license or technology if based on units produced, hire charge of the plant and machinery used on hire if based on the units produced. When royalty or hire charges are based on units produced, these expenses directly vary with production. Let us take some notings. Entities, that is business organizations are of two types: trading entities manufacturing entities. Manufacturing entities. The final account of trading entities consists of trading account, profit and loss account, and balance sheet and balance sheet. The final account of manufacturing entities consists of manufacturing account, manufacturing account. Manufacturing account basically means cost sheet. Why we prepare cost sheet? To compute the total cost of manufactured goods. Total cost of manufactured goods plus trading account plus profit and loss account plus balance sheet. What is cost? Cost is the amount incurred. Cost is the amount incurred for production of goods or providing of services. Providing of services. Cost comprises of cost comprises of material cost, that is all raw material including consumables. Next is labor, whether doing production or not. Labor, whether doing production or not, all manpower. And expenses, cost, cost 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 other than material and labor, electricity, rent, etc. Next is classification. Kindly write based on based on nature of cost. Classification based on nature of cost. Direct cost, and indirect cost. Direct cost and indirect cost. In direct cost consists of three types of cost: direct material, direct labor, direct expenses. Direct material, direct labor, and direct expenses. Together, these cost is known as prime cost. Direct cost plus direct labor, direct material plus direct labor plus direct expenses is known as prime cost together. Indirect cost is indirect material, indirect labor, indirect expenses. Cumulatively, it is known as overheads. Or we can call it as factory overheads, or manufacturing overheads, or production overheads. I believe you understood till here. Let us draw the format of manufacturing account or cost sheet. Manufacturing account. Manufacturing account, which is also known as cost sheet. Particulars amount. We'll begin with opening stock. Opening stock of direct material. Opening stock of direct material. We'll write the amount in internal column. Then plus purchases of direct material less less closing stock of direct material less closing stock of direct material. The figure we'll receive is direct material consumed. This is direct material consumed. Opening stock of direct material plus purchases minus closing stock of direct material, you will receive direct material consumed. Direct labor needs to be added into this. Direct labor directly to the outer column plus direct expenses plus direct expenses. The summation of all these figure will give you prime cost. Prime cost now plus manufacturing overheads. Manufacturing overheads means manufacturing plus manufacturing overheads. This will give you gross manufacturing cost. Gross manufacturing cost. Gross manufacturing cost plus opening WIP, opening work in progress, less closing work in progress, closing work in progress. This will give you net manufacturing cost. Net manufacturing cost. This is also known as cost of goods produced. Cost of goods produced. That's it. So this was manufacturing account. Next is cost of sales. How to calculate cost of sales? Cost of manufactured goods. Cost of manufactured goods that we have calculated through cost sheet minus plus opening stock of finished goods less closing stock of finished goods This will give you cost of sales. Let us move ahead. Illustration 1. 1 lakh units were produced in a factory. Per unit material cost is rupee 10. Per unit of labor cost is rupee 5. What agreed to pay a royalty of rupees 3 per unit. That apart it was agreed to pay royalty at the rate rupee 3 per unit to the Japanese collaborator who supplied technology required calculate manufacturing cost. In this case, we have direct labor over here, that is rupee 5 per unit, direct material, that is rupee 10 over here, rupee 10 per unit, and this rupee 3 per unit is nothing but direct expenses. Direct expenses. So we'll calculate manufacturing cost. Solution. Solution. Calculation of manufacturing cost. Calculation of manufacturing cost. Particulars rupees. Particulars amount. Raw material consumed. Raw material consumed. 1 lakh units multiplied by 10, 10 lakhs. 1 lakh units multiplied by rupee 10 per unit, this is 10 lakhs. Next is direct wages. Direct wages, that is 1 lakh units multiplied by rupee 5 per unit, which is 5 lakhs. And then direct expenses, that is royalties. Direct expenses, that is royalty, 1 lakh unit multiplied by rupee 3, which is 3 lakhs. 10 plus 5 plus 3, total 18 lakhs. 18 lakhs. Manufacturing cost is 18 lakhs. Let us move ahead. Indirect manufacturing expenses or overhead expenses. These are also called manufacturing overhead, production overhead, works overhead, or overhead, that is overhead. So overhead is defined as total cost of indirect material plus indirect labor, that is indirect wages, and indirect expenses. Overhead equals indirect material plus indirect wages plus indirect expenses. Indirect material. What is indirect material? Indirect material means material which cannot be linked directly with the units produced. For example, stores consumed for repair and maintenance work, small tools, fuel, lubricating oil, etc. Next, indirect wages. Indirect wages are those which cannot be directly linked to the units produced. For example, wages for maintenance work, holiday pay, holding pay, etc. Third, indirect expenses. Indirect expenses are those which cannot be directly linked with the units produced. For example, training expenses, depreciation of plant and machinery, depreciation of factory shed, insurance premium for plant and machinery, insurance premium for factory shed, etc. Accordingly, indirect manufacturing expenses comprise indirect material, indirect wages, and indirect expenses of the manufacturing division. I repeat, manufacturing division. Next is byproduct. In most manufacturing operations, the production of main product is accompanied by the production of subsidiary products which has a sale value. For example, production of hydrogenated vegetable oils is accompanied by production of oxygen gas, and the production of steel yields scrap. The subsidiary product is termed as the byproduct, which automatically produce. The company is not having the objective to manufacture byproduct because its production is not consciously undertaken but results out of the production of the main product. It is usually very difficult to ascertain the cost of the product. Moreover, its value usually forms a very small percentage of the main product. Byproduct is a secondary product. This is produced from the same raw material which are used for producing the main product and without incurring any additional expenses from the same production process in which the main product is produced. Some examples of byproduct are given below. First, molasses is the byproduct of sugar manufacturing. Sugar is the primary main product. Molasses is the byproduct which produces automatically. Buttermilk is the byproduct of dairy which produces butter and cheese. Butter and cheese are the main product. Buttermilk is the byproduct, but it also have a sellable value. Byproduct generally have insignificant value as compared to the value of main product. They are generally valued at NRV, net realizable value. If their cost cannot be separately identified, it is often treated as miscellaneous income, but the correct treatment would be to credit the sale value of the byproduct to manufacturing account, so to reduce to that extent the cost of manufacture of main product. Let us continue. Design of a manufacturing account. Let's see the design of a manufacturing account. How a manufacturing account is prepared. So there is no standardized design for the presentation of manufacturing account, but still a format covering various elements is given over here. On the debit side, we have raw material consumed. We have learnt how to calculate raw material consumed. Opening inventory plus purchases less closing inventory will give us raw material consumed. Direct wages, direct expenses will give us prime cost. Factory overheads like royalty, hire purchases, indirect expenses, repairs and maintenance, depreciation, factory cost, opening WIP. On the credit side, byproducts at NRV, net realizable value, by closing WIP, work in progress, by trading account, cost of production is calculated. I believe you understood. Let us continue. Tutorial note: frequently problems are set in which all the ledger balances are not given. Instead, details are given regarding the number of items in inventories, quantity manufactured, etc. The figures for inventory, sales, etc. would therefore have to be worked out independently from the data given. The following general rules may be observed. First, the manufacturing account should have columns showing the quantities and values. Frequently, all the quantities are not given and the quantities applicable to one or more of the items would have to be worked out. For example, if the question does not state the total number of items sold, the quantity can be worked out by adding opening inventory and units manufactured and deducting the closing inventory. It is therefore useful to have quantity columns in the account so that it can be seen that both side balances. The manufacturing account will show the quantity of raw materials in inventory at the beginning and at the end of the year and the purchases during the year. As regards finished goods, it will only show the quantity manufactured, and as regard work in progress, the opening and closing amounts. The trading account will show the quantities of finished goods manufactured and sold, and the opening and closing inventory. It will not show the quantity of raw material or WIP. For determining the value of closing inventory in the absence of specific instructions to the contrary, it must be assumed that the total sales have been on the FIFO basis, first in first out. That is, the closing inventory consists as far as possible for goods produced during the year, the opening inventory being sold out. It may be mentioned here that nowadays no manufacturing business entity prepares manufacturing account as a part of final set of accounts. Even the items of manufacturing account are shown either in trading account in case of non-corporate entities or in statement of profit and loss account in case of corporate entities. The procedure for preparation of trading account, profit and loss account, and balance sheet have already been explained in Unit 1 of this chapter. Students should refer the earlier unit of attempting the problems based on the preparation of complete set of final accounts of sole proprietor. I believe you understood. Let us begin with illustration 2 now. Consider the following information and answer question 1, 2 and 3 given below. Opening date is given 1st January. Closing date is given 31st December. Stock of raw materials is 17,400 and 18,100. WIP is given. Stock of finished goods is given. During the year, manufacturing overheads expenses amounted to 61,100. Manufacturing wages is 40,400 and purchase of raw materials is 91,900. There were no other direct expenses. Question: the cost of raw material consumed, issued and used were. The cost of raw material consumed, issued and used were. We need to calculate it. Question 1. Solution 1. Opening stock of raw material. Opening stock of raw material 17,400 plus purchases 91,900 minus closing stock minus closing stock of raw materials minus closing stock of raw material 18,100. $91,200. This is consumption. Consumed. Next question. So 91,200 answer is B. 1B. Second, the manufacturing cost of finished goods produced were. The manufacturing cost of finished goods produced were. Second, consumption of raw material 91,200 plus direct labor plus direct labor 40,400 manufacturing wages 40,400. This is prime cost 131,600. This is prime cost plus overheads 61,100. Total it 192,700. This is gross factory cost 1,92,700 plus opening work in progress 11,200 minus closing work in progress 11,400. This is 192,500. Net cost of manufactured goods Next question. Question 3. The manufacturing cost of finished goods sold was, it is 192,500. Second, D. Question number 2, D. Question 3. The manufacturing cost of finished goods sold was, question 3, cost of goods sold. Cost of goods sold. Cost of manufactured goods. Cost of manufactured goods 192,500 plus opening stock of finished goods 41,500 minus closing stock of finished goods equals 193,300. This is cost of goods sold, COGS. Cost of goods sold. I believe you understood till here. I believe you understood. Let us quickly do the MCQ. Under statement of closing stock, under statement of closing work in progress in the period will A. Understate the cost of goods manufactured in that period. B. Overstate current assets. C. Understate net income in that period. D. None of the three. It is C. Understate the net income of that period. Understatement of closing work in progress will understate the net income of that period. Next question. Question 2. Sales is equal to cost of goods sold minus gross profit. B. Cost of goods sold plus gross profit. C. Gross profit minus cost of goods sold. Or D. Net profit plus cost of goods sold. It is B. Sales equals cost of goods sold plus gross profit. Next question. Question 3. Indirect manufacturing expenses is also called A. Manufacturing overhead, B. Production overhead, C. Works overhead, or D. All of the above. It is D. All of the above. Indirect manufacturing overhead is called production overhead, manufacturing overhead, and works overhead. Next question. Question 4. Sale value of the byproduct is credited to A. Manufacturing account, B. Capital account, C. Overhead account, D. Trading account. It's A. Manufacturing account. Sale value of the byproduct is credited to manufacturing account. Next question. Question 5. Manufacturing account shows A. Total cost of manufacturing the finished products. B. It provides details of factory cost. C. It facilitates reconciliation of financial books and cost records. Or D. All of the three. It's D. All of the three. Manufacturing account shows total cost of manufacturing the finished product. It also shows it provides details of the factory cost, and it facilitates reconciliation of financial books with cost records. Next question, theoretical. Write a short note on byproduct. And question number 2, differentiate between direct manufacturing expenses and indirect manufacturing expenses. Byproduct generally have significant value as compared to the value of main product. They are generally valued at net realizable value. If their cost cannot be separately identified, it is often treated as miscellaneous incomes, but the correct treatment would be to credit the sale value of the product, of the byproduct, to manufacturing account so as to reduce to that extent the cost of manufacture of main product. B. Direct manufacturing expenses are cost other than material or wages which are incurred for a specific product or sellable services. Indirect manufacturing expenses are also called manufacturing overhead, production overhead, works overhead. Overhead is defined as total cost of indirect material, indirect wages, and indirect expenses. We are stopping here. We are stopping here. Thank you. Thank you.